All right. Good morning, everybody. Good morning, all you magnificent melon heads of the world. Happy Wednesday, everybody. Today is August 13th, 2025. And the top story this morning is this mysterious rise in the price of silver. Silver's having a good morning here. It's up like 1.5%. And, that by itself, not that big a deal. I like the shiny. You guys know that about me. But we're not seeing a matching move in gold. Silver's kind of running by itself here this morning. Gold is up. It's up a little bit, but nowhere near the move that we're seeing in silver. And that kind of makes me wonder, is there some other news out there? I couldn't find anything. I went looking. No big stories about some big silver mine shutting down. No big bank covering it short or any of the other stories that you might expect would move prices. It's just moving by itself here. We're seeing the gold to silver ratio come down. And look, the reason why I think that's important, the reason why that rises to the level of inclusion in the title this morning is the fact that I think silver is really overdue for a pretty sizable rip here. We watched the gold to silver ratio move as high as over 100 earlier this year. We have since come down. I'm going to show you a couple things in the charts, a couple of technical signs that tells me gold is probably going to run here, probably setting up for a nice breakout to the upside, even after the move it's already made. And that silver is probably going to even outpace that move. That's why I think that is such big news this morning. And of course, you know me, I like the shiny. Other news going on this morning. Coreweave reported earnings yesterday. Company you may have noticed, I like to talk about these guys. Coreweave posted phenomenal revenue, big revenue beat, nice revenue growth, but a wider than expected loss. And oh, that's right. The whole point of this whole thing of business is to make money. At the end of the day, Coreweave doesn't make money. They're great at collecting revenue, but what they spend is more than that, which means they are losing money, which means if you're holding this company, you're slowly bleeding out, even though admittedly Coreweave has had a phenomenal run this year, partly because such a small number of shares was sold to the public with the IPO. They downsized it at the last minute, a move that worked out to the advantage of Magnetar Capital. But look, here's the skinny of it. Revenue grew by $817 million. It was like $1.2 billion or something like that. It was a big beat on revenue by a pretty wide margin, 206% growth in revenue. But the problem is accounts receivable grew by $1.51 billion. Or 364%. You guys probably know, or you may have heard me say this, when accounts receivable is growing faster than revenue, that's a red flag. When accounts receivable is growing a lot faster than revenue, almost twice as fast as revenue, that is a great big giant red flag. And it's also a sign of channel stuffing. It's a sign of early revenue recognition. And you might be like, well, there's no evidence to suggest the Coreweave guys would engage in any kind of accounting shenanigans other than the fact that they once ran a pump and dump scam called Cicerex and that they used to trade carbon credits through shell companies in the Cayman Islands and that they're hooked up with Magnetar Capital, the sleaziest hedge fund in the history of the world. Other than all that, there's no evidence to suggest they would ever do anything in the accounting realm that might be considered untoward or conduct unbecoming of a publicly traded company responsible for a $20 trillion stock bubble. Nothing to see here. Move along. Also, their interest expense is now more than their operating income. That's fun. We lose money on every transaction, but it's okay. We make up for it in volume, right? Their debt is now over $11 billion. And to meet their CapEx targets, they're going to need to take on at least another $10 billion before the end of this year, which is only in the next couple of months. Guys, this company is dead money. It's been dead money for a while. The share price could go up. These guys could engineer some kind of a headline. They could announce a merger with some company using money that they don't have. Look, these guys are sharp, and they have played this market like a fiddle for years, so maybe they're able to keep it up for a little while longer. But at the end of the day, Coreweave is dead money. It is a mathematical certainty. They just light money on fire. Also going on this morning, we've got an article in Reuters. This is interesting. The United States has started putting GPS trackers in AI shipments that they suspect are secretly being rerouted to China. It's nice of the BIS and the DOJ to finally get on top of this issue. We've been reporting on this for well over a year now on this channel, along with several others on X, have been pointing out that just as soon as the U.S. banned the sale of these advanced AI chips to China, well, suddenly NVIDIA and their suppliers started doing a suspiciously large amount of sales in Singapore and Malaysia. And the U.S. is finally starting to catch on that they're just routing the chips to China through those countries. And so they started to put trackers on there. Maybe that's got something to do with those two guys in California who just got arrested earlier last week. Did a video on that one last week. We've got Circle, the crypto company, the issuer of the USDC stablecoin. They are down big today because they just issued a bunch of new shares. Look, Circle stock ran like crazy with their IPO, much the same way Coreweave did. This year's class of IPOs, it's been very small, but those who have IPO'd have ripped on the news. Circle's taking advantage of that, and they're issuing new shares. Just keep an eye on that, guys. These crypto companies, they have run like crazy. We are getting dangerously close on the calendar to historically when crypto winter would kick off. We've also got restaurant chain Cabba. They reported earnings. That stock is down big. They're getting clobbered here on a disappointing growth in same-store sales. Look, that's a restaurant that was trading at like a 70 PE. Restaurants just shouldn't trade at multiples like that. This thing got ahead of itself. It's way overvalued. Stock coming back down to earth. We've got a going concern over at Spirit Airlines. That story broke yesterday. Another sign of the consumer struggling. The budget airline, they're only 5 months out of bankruptcy, and they're already using words like going concern again, which means they might be headed right back into bankruptcy. Another sign that the consumer is not doing well. Also, we got a story in Bloomberg this morning, a chart I want to show you guys about the cost to rent versus the cost to own and why I think that is such a big deal. And we've got PIK usage, payment in kind among private credit borrowers is surging. Payment in kind is when they don't actually pay their debts. They just say, oh, you know what? I don't have any money because my business never made any money. I can't service the debt that I borrowed from you. So instead of paying you interest, we're just going to make the principal bigger and we'll call it payment in kind. Well, that is gaining in popularity among private credit. Hey, just in time for them to sell this stuff into your 401k, thanks to President Trump's recent executive order allowing private assets into retirement accounts. Guys, there is a lot going on this morning. Why don't we shrink my big melon of a head and let's see what's going on in the markets? And hey, this is when I usually say, please, if you feel so inclined, hit that like button and that subscribe button for the YouTube algorithm. If you're new here, so you can come on back tomorrow and have your coffee with the melon heads as we go through markets. And we have got stocks are set to open at yet another all-time high here. In lieu of catastrophe, number go up. Today is no exception. We're watching this melt up continue. The S&P higher by 19 points, 0.3% to the upside ahead of the opening bell. The Dow doing even better, up by 0.37% or 163 points in the green this morning. Also looking like a record. And, of course, the NASDAQ leading the way higher, up 0.39%, 93 points to the upside for the tech-heavy NASDAQ. Stocks are being buoyed here by the increased likelihood of the Federal Reserve cutting rates in September, especially after yesterday's inflation print. And we've got a dollar that reflects that reality this morning. The DXY is weaker by another 20 basis points, 97.87 for the Dixie. Weaker dollar will be putting upward pressure on asset prices this morning, as will the lower interest rates. We've got rates are heading lower across the board this morning. The 30-year Treasury, 4.847. That's down by almost 4 basis points this morning. The 10-year, meanwhile, is at 4.263. That's off by 4.5 points. The 2 years at 3.687. That's off by 4 points and change. And the 1 month is at 4.309, lower by a half a point. Now, we got a weaker dollar. We've got lower interest rates. That should be rocket fuel for precious metals here. And, well, it kind of is. It kind of isn't. Gold is up this morning, about $8 higher, 0.25%, $3,356.47 for spot gold. But it's silver that is really moving here. And I really like this move in silver. First of all, spot silver, 38.42. That's higher by 50 cents, 1.34% higher. It was a little higher a few minutes ago. But the other thing you'll notice, the move in spot and the move in the front month contract, that September contract, is at 38.50. Spot is at 38.42. We're no longer seeing that exchange for physical premium blow up. This has nothing to do with tariffs and the difference between London and New York. We've got roughly equal moves. Both spot and the front month contract are up by 50 cents this morning. This is a good old-fashioned organic price move in the price of silver. It's just going higher, not on some technicality or some silly policy wonk said a thing. It's just going up this morning. Now, we're going to look at the charts in just a second and show you why I'm so encouraged by this. Meanwhile, let's just touch on the other commodities real quick. Copper is down by 1/3%. Platinum is off by about 0.5%. Palladium is down 0.8%. And WTI crude oil is off by about a dime here, $63.07. For September WTI futures, those are lower by 0.16%. All right, let's look at a couple of the charts here. First things first, gold looks pretty good here. Even though gold's not moving so much today, we do have gold has been kind of putting in this ascending triangle pattern, and that would suggest that we are looking at a breakout to the upside at some point just as soon as we break out of this pattern. We've kind of struggled with this 34.50 level 1, 2, 3, 4 times now. And you may notice if we zoom in here, gold is hovering right around its 50-day moving average. Closed right on that yesterday, opening higher this morning. So it looks like we may be getting some support there at the 50 line. But gold looks to be set to move higher here. The other reason why I think this looks pretty good here is silver actually looks set to move higher here. Silver caught a nice bounce off the 50-day moving average back at the beginning of this month, and it has continued to move higher since. So got the chart on gold looks pretty good. The chart on silver looks pretty good. Now look at the gold to silver ratio. This is the price of an ounce of gold divided by the price of an ounce of silver, or the number of ounces of silver that it takes to make an ounce of gold. And they're seeing a couple of things. First of all, we went to this obscenely high level of about 105 back in April. That was your first clue that silver was getting set to rip. It's not unheard of, but it's very rare to see it go that high. I have only ever seen it one other time. But the technicals in the gold to silver ratio also look pretty good. You may notice we rejected the 200-day moving average on the gold to silver ratio. That was starting to tick higher. Silver was starting to underperform gold a little bit, ran up against that 200 line and rejected it. Now it's moving lower. And that happened right at this death cross where the 50-day moving average crosses below the 200. Now, let me just add, guys, we're talking about a ratio here. So technical indicators on a ratio, you could argue that this is a bit of a stretch here and that we're reading too much into this. That being said, we have these two majorly bearish indicators on a ratio chart. Now, that doesn't necessarily say much about the price of gold or the price of silver by itself. What this is telling me is that the gold to silver ratio could be heading sharply lower. And if both gold and silver are looking good, technically indicating they're heading higher, that means silver could be set up to vastly outperform gold here. And that is why I like the shiny. I've always liked the shiny, but I really like it this morning. All right, let's talk also a little bit about Bitcoin, 120,542, back above that 120 threshold. Bitcoin could be set to break out here. I also want to point out, guys, that 122, 123 level, we hit that twice and could not hold it, not even for a couple of hours here. So watch Bitcoin over these next few days here. We're looking pretty good at 120,000. But again, be careful on leverage. It is now the middle of August, and historically, something very bad happens in crypto within 18 months of a halving. And 18 months from the halving would be sometime in October of this year. So we're getting pretty close to what would be the onset of crypto winter. I have no idea what's going to trigger it. My guess is these Bitcoin treasury companies are getting a little too ahead of themselves, taking on too much leverage. And that could be what blows it up this time. Or there could be some massive fraud somewhere that takes them down, a la FTX or OneCoin or BitConnect. Meanwhile, Coreweave's mixed earnings fail to wow the AI bulls and the stock falls. The company beat revenue expectations on unprecedented AI demand, because AI demand is only ever unprecedented. This is a boring recycled talking point, but I digress. They posted a wider loss than analysts were predicting. Coreweave has enjoyed an impressive run since going public in March, with its stock up nearly 300% from its IPO price, and the company continued to see robust demand for its services throughout the second quarter. though the stock is cooling in the wake of the latest results. While Coreweave beat revenue expectations for the period it disclosed on Tuesday, a steeper loss than analysts were anticipating, and shares fell 10.4% in the extended session. Coreweave reported second quarter sales of $1.2 billion, up roughly 200% from a year earlier. The CEO Michael Intrater said the AI cloud computing company is scaling rapidly as we look to meet the unprecedented demand for AI. There's that unprecedented demand again, that insatiable appetite, that talking point du jour. But again, guys, that 200% increase in revenue, that goes along with a 364% increase in accounts receivable. It means the only reason they're able to make those revenue numbers look so nice and juicy is because they're prematurely, or there is suggestion that they are prematurely recognizing that revenue in order to maintain that top line growth, which is not sustainable, and that is a big accounting red flag. The company also flagged $30.1 billion of revenue backlog as of June 30th. Management pointed out the capacity is likely to remain constrained going forward as power supply for data centers remains a key bottleneck. Now, look, they're talking about this big backlog of revenue, which is just the sum value of all of the contracts that they've signed from now through completion. Okay, that's great. But then in the next sentence, they're saying, hey, we're having trouble managing power. We're having trouble building our data centers. Well, you need to build your data centers in order to ever get that revenue. And well, you're telling us you're having problems because of power and because of transformers. That doesn't exactly give me a lot of confidence that that revenue is going to materialize. Also, you need to take on another $20 billion in debt in order to do it. That's a whole other issue. While the sales numbers wowed, Coreweave posted a wider than expected loss last quarter. The company reported a net loss of $291 million, while analysts had only expected a $199 million loss. Management attributed the wider loss to heavy spending on customer acquisition and infrastructure, citing the upfront costs required to support the company's rapid growth. The adjusted net loss deepened as well to $131 million, amounting to a negative 11% margin and missing consensus expectations for a $103 million loss. In the same quarter of the last year, the company reported a loss of $5 million with a negative 1% margin. So the losses are getting bigger. The losses are getting negativer, more negative. The accounts receivable blowing up in order to inflate the revenue numbers. The interest exceeds their operating income. Guys, this company, it's just dead money. But try explaining that to the Coreweave bros on Twitter. Good luck to you. Right now, Coreweave stock down 10.5%, but still trading at $133, more than 4 times their IPO price. This thing has a long way to fall, guys. Now, look, there may be another up move coming soon. Honestly, I just couldn't tell you. Never underestimate this company's ability to play this market like a fiddle. They will say something about AI. They'll sign some contract involving money they don't have with a company run by people with a rap sheet, and yet people will buy the stock off of it. So is the bubble going to burst today? Again, probably not. Meanwhile, we got another AI story this morning. U.S. embeds trackers in AI chip shipments to catch diversions to China. Sources say, oh, yeah, that thing that isn't happening. That's why they're putting trackers in GPU shipments, right? Because that thing isn't happening. U.S. authorities have secretly placed location tracking devices in targeted shipments of advanced chips they see as being at high risk of illegal diversion to China, according to 2 people with direct knowledge of the previously unreported law enforcement tactic. The measures aim to detect AI chips being diverted to destinations which are under U.S. export restrictions and apply only to select shipments under investigation, the people said. 5 other people actively involved in the AI server supply chain say they are aware of the use of trackers in shipments of servers from manufacturers such as Dell and Supermicro, which include chips from NVIDIA and AMD. Those people said the trackers are typically hidden in the packaging of server shipments. They did not know which parties were involved in installing them and where along the shipping route they were put in. Reuters was not able to determine how often the trackers have been used in chip-related investigations or when U.S. authorities started using them to investigate chip smuggling. The U.S. started restricting the sale of advanced chips by NVIDIA, AMD, and other manufacturers to China in 2022. In one 2024 case described by 2 of the people involved in the server supply chain, a shipment of Dell servers with NVIDIA and chips included both large trackers on the shipping boxes and smaller, more discrete devices hidden inside the packaging and even within the servers themselves. So it looks like the DOJ is finally starting to take this issue seriously. We finally are starting to get some arrests. We had those 2 guys were arrested in California last week, although mysteriously the accounting firm that was running the paperwork and the CEO of the company were not arrested for some reason. Maybe they will be arrested soon. But at the very least, they're finally starting to take this issue seriously. Meanwhile, we've got Circle falls after the company and holders offer 10 million shares. This is the problem with these IPOs that triple or quadruple in their first couple of days of trading. It almost guarantees that some kind of dilution is coming. And we got that from Circle. Shares of Circle Internet Group fell after the second largest stablecoin issuer and a group of shareholders, including co-founder and CEO Jeremy Allaire, announced an offering to sell a combined 10 million shares. Circle is offering 2 million shares, while the selling shareholders are selling 8 million, according to the filing on Tuesday with the U.S. SEC. At the closing price on Tuesday of $163.21 each, the share sale would raise $1.63 billion. The stock declined 6.1% from its closing price. The offering is set to price Thursday night, according to people familiar with the matter who asked not to be identified, as the information isn't public, and a representative for Circle didn't immediately respond to a request for comment. Circle went public in June in an IPO that raised $1.2 billion and has seen its stock price rise more than 426% through Tuesday's close after a stablecoin bill was signed into law. The share sale comes within 6 months of the IPO, a period in which certain early shareholders typically are barred from selling their shares, but shareholders can be released from the so-called lockup agreements when the stock is up substantially from the IPO price, as this one is, and there is clear demand for the shares. Circle insiders had agreed not to sell before a few days after the release of the company's September quarter results, or 180 days after the IPO, whichever came first. According to its earlier filings, well, the shares ripped 400%. And so that looks like that lockup period is over earlier. And Circle is down this morning, off by $6 here, or about 3.5% lower. But let's put that in perspective. Circle shares have ripped after the IPO. They first started trading around $65. I think the IPO price was something closer to like $40. So sitting here trading at 160 and change, things could be a lot worse for Circle shareholders. Meanwhile, we've got Cabba stock plummets after the company lowers their forecast on disappointing same-store sales growth. More bad news in the restaurant business, and this is from one that was previously doing pretty well. Cabba on Tuesday lowered its full-year forecast for same-store sales growth after a disappointing second quarter. For the full year, Cabba now anticipates same-store sales growth of 4 to 6%, down from its prior range of 6 to 8%. So look, 4 to 6%, still pretty good, but when you previously forecast 6 to 8%, that's going to disappoint your investors. Shares of the company plunged more than 20% in pre-market trading Wednesday. The stock has fallen 40% this year, including the after-hours move. The chain's same-store sales, a metric that only tracks the performance of restaurants that have been open at least a year, rose 2.1% in the quarter. While Cabba managed to buck the industry trend of same-store sales declines, Wall Street was projecting growth of 6.1%, according to the street account estimates. And look, we've had a couple of other fast food chains and fast casual restaurants, if you will, that have done pretty poorly here. Rival fast casual chains have also struggled this quarter with slumping sales. Chipotle Mexican Grill reported same-store sales declines of 4%, while salad chain Sweet Green saw its stock plummet after the company cut its outlook for the second straight quarter. And Cabba shares not doing so hot this morning, down 21.4% ahead of the open, trading at $66.55, off by more than $18. Look, guys, this is a restaurant stock, and it was trading at a PE of more than 70. That's kind of obscene. This thing was just ridiculously overvalued. They're still putting up halfway decent growth numbers, but not good enough, not when you previously forecasted 6 to 8%. All right, now we got this article in Bloomberg this morning. Americans are getting priced out of home ownership at record rates. Now, look, this is a story that I've talked a lot about. Entire generations priced out of the home market, about how it's unsustainable. It's not so much the anecdotes and the statistics in this article that I wanted to point out. It was this chart that's about 2/3 of the way down here. All right, this chart here, what they're showing is in red. The red circle is the cost to buy a home, the monthly ownership cost, if you will, the mortgage payments, the maintenance costs averaged, and all that other stuff. And then the black number, that black circle, that is the cost to rent. Right now, they've got what it used to be in 2021 shown there in the lighter shades. Don't worry so much about that. But the point is, if you look here, the red number is further out than the black number for virtually every city in the country. And in some cities like Los Angeles, it's almost 3 times or more than double. The cost to buy is more than double the cost to rent. All right. Every single city on this chart, the cost to buy is far in excess of the cost to rent, with one exception, Pittsburgh, Pennsylvania. It's cheaper to buy than rent. That's the one city in the country where it's still cheaper. The point is, guys, I'm not worried so much about the generations priced out of the home market and everything. I've talked about that before, all right? The point is here, I get a lot of comments about how, oh, BlackRock is buying all the houses, which that's not technically true. BlackRock actually hasn't been buying single-family homes. Blackstone has been buying a lot of single-family homes, but there have been a lot of hedge funds and asset managers and institutions that have been out there buying up single-family homes for the purposes of renting them out. And a lot of people have been calling for this ban on institutional ownership of single-family homes. And I've never really gotten down with that. I'm not a fan of government banning things in general. The point is, look at this chart. Look at how much more expensive it is to buy houses than it is to sell houses, or than it is to rent houses. And if all of these institutional owners are out there buying up houses and then renting them out, well, then according to this chart, they're all losing money. And I've said all along, the solution to this problem of the institutional managers coming in and bidding up the price of homes is to do nothing, because that business model is going to fail. This chart is showing us that that business model is going to fail. The cost to rent is cheaper than the cost to own. And if you're Blackstone here, you're paying the red and you're earning the black. It means you're losing money on every transaction, on every house that you buy. Let them lose money. Let them go bankrupt. Let them be forced to sell. And then the millennials and the Gen Zers who have been priced out of the housing market will have an opportunity to buy those homes out of foreclosure on the cheap. Just do nothing. That's the solution here. Now, it becomes a problem when government bans come in, or when we try to legislate our way out of this. They almost always include carve-outs for the big money because they can afford lobbyists. And the other problem is the bailouts. When these firms start to flounder, and they will, let them die. Let them lose money. Don't bail them out. Don't say, oh, they represent an existential risk or a systemic risk to the financial system, and so we need to print money and make everybody poor in order to save the rich people for their own good. Let them fail, because they will fail. This chart is telling us that they're going to fail. Every single city in the country, except for Pittsburgh, all right, things are looking really good for institutional landlords in Pittsburgh. Everybody else is screwed. Meanwhile, private credit's PIK usage nears a 4-year high, Lincoln says. Pay attention, guys, because this is one of those things that they just gave the green light to dump into your 401ks. The share of private credit borrowers that deferred at least some of their cash interest payments surged in the second quarter to the highest in almost 4 years, pointing to growing stress in the $1.7 trillion with a T dollar market, according to data from valuation firm Lincoln International. The percentage of debt investments with some sort of payment in kind increased to 11.4% in the quarter, according to Lincoln. That compares with 7.4% in the third quarter of 2021 when the firm began tracking the data. So they're saying it's the highest it's been in 4 years. That's not accurate. They've only been counting for 4 years. It's the highest they've ever seen it. They've just been looking for 4 years. But again, guys, payment in kind, or PIK, that's when they're not actually paying the interest. They're not actually making the payments on their debt. They're just making the principal bigger. It's basically like forbearance for private credit. 11.4% of the loans in this category are doing this, not paying. Because why? Because they're loans to companies that don't have any cash flow. They can't pay it back, which means those companies are worth less than they admitted. They're worth less than they're claiming on the books. Changes in average loan-to-value metrics, which measures the ratio of a company's indebtedness to the total value of the assets, are also suggesting pressure. LTVs for companies with bad PIK increased to 83% on average in the second quarter. That's compared to 45% at origination, according to the report, and what Lincoln called a clear sign of stress. The principal is getting bigger. The value of the underlying assets or the collateral is going down. There are bad things happening in private credit. Nobody can pay their bills, and they're trying to sell this stuff to your 401k. Guys, be vigilant about this stuff. Open up that prospectus. Know what's in the fund. If you don't know what something means, Google it or ask somebody to explain it to you, because this stuff is hiding everywhere, and they're looking for bag holders. And the perfect bag holder is the person who just passively dumps money into his account and never looks at where it's going. Meanwhile, we got this one this morning. Spirit Airlines warns it might not be able to survive without more cash. Another sign of struggling consumers. You can put this along with the restaurants that aren't doing too well. But Spirit Airlines, man, this seems like a story we've already read, because they're only 5 months out of bankruptcy. Spirit Airlines has warned it might not be able to survive as a going concern if it doesn't raise more cash 5 months after the budget travel icon emerged from bankruptcy. After cutting its debt during restructuring, Spirit has tried to attract bookings by marketing more upscale products and looking for new ways to lower costs. Late last month, the airline announced plans to furlough 270 more pilots this fall. However, the company has continued to be affected by adverse market conditions, including elevated domestic capacity, continued weak demand for domestic leisure travel in the second quarter of 2025, resulting in a challenging pricing environment. In other words, the economy is in a recession, even though nobody wants to admit it. People aren't flying, and Spirit Airlines might be going back to bankruptcy. This story just broke yesterday. And last but not least for today, guys, let's talk about mortgage applications. Mortgage applications for the week ending August 8th surged by 10.9%. People really liked those lower mortgage rates. Let's see, applications to refinance a mortgage, which are more sensitive to short-term changes in interest rates, surged by 23% from the earlier week and extended the 5.1% jump from the period that ended at the end of July. A 23% surge in refis because we got a 10 basis point reduction in the average mortgage rate. Who the heck is refinancing at today's interest rates? Desperate people, that's who. Or cash out refis. That's what we're seeing here. People using their homes as ATMs. Not exactly a good sign. And again, all of that was based on a measly 10 basis point reduction in the average 30-year interest rate from 6.77% down to 6.67%. But don't be surprised to see that number start to move forward now that everybody is talking about rate cuts over at the Federal Reserve. The Fed lowering the short end has a way of making the long end move higher, especially if people think inflation is going to be making a comeback, which it's sure to do because they're cutting too soon. And I just want to say thank you to Steve Woitis. Thank you, Steve, for the reminder. I was supposed to mention this and I forgot. Ethereum is ripping. Why? Look, Ethereum is ripping. It started to rip ever since the Genius Act passed is when Ethereum really started to make this move. I think the stablecoin legislation, it's got the DeFi guys getting all excited. I am not particularly excited about this. I own a little bit of Ethereum. I mined it some a couple of years ago, and I never sold it. Ethereum is ripping, but let's put that in perspective. Ethereum is ripping to the price it was at in 2021. All right, Bitcoin blew away its 2021 high months ago, more than a year ago. Bitcoin blew out its 2021 high. So Ethereum's just playing catch up here. Is Ethereum going to keep ripping? Maybe. But in my opinion, this rip in Ethereum is too little too late. I think this halving cycle is just about run its course. Maybe we got one more big leg higher for Bitcoin here before something happens and we start to move lower. There's some people out there are saying, no, because of ETFs, this time is different and we're not going to have crypto winter. I don't buy that one bit. So I'm not so worried about the why. I think it's tied to the Genius Act and the stablecoin legislation. And look, Ethereum, smart contracts, all these other shit coins are based on the Ethereum blockchain. So maybe it's just a sign of froth building up elsewhere in the crypto market, taking Ethereum with it. Again, I own a little bit. I like to see the stuff I own going higher, but I'm not like jumping out of my chair for excitement. You may have noticed over what's going on with Ethereum. Maybe I'll sell my Ethereum and buy Bitcoin with it. I don't know. It's a small amount. That's all. Thank you very much, Steve Woitis, for supporting the channel, sir. I appreciate the super chat. And thank you very much to Break My Wallet Motorsports, who says Cabba is gross. I've never eaten at Cabba. I couldn't tell you. It's just not my thing. Look, Cabba's doing okay. I mean, their same-store sales growth numbers were lower than they were supposed to be, certainly lower than they've been. About a year ago, Cabba started ripping. They produced some kind of new, like, grilled steak option on their menu I was reading about that said, that brought people in. Now that's about a year ago, so those comps are getting very difficult to match. Same-store sales are starting to show a little bit of weakening growth here. But that being said, Cabba's outperforming most of their peers in the fast casual space. I think this is just one that ran too far too fast, and it's got to come back down to earth. I'm not going to pass judgment on the food because I've never eaten there, but I hear good things. And now, thanks to Break My Wallet Motorsport, I also hear bad things. So let me know in the comments. Is Cabba any good? Maybe I'll go there, maybe not. Thanks again, Break My Wallet. Nashville Pasta Man, what's going on, sir? He says, is the goal to make money for commercial buyers, or is it to structure bonds to sell into retirement funds that get paid on the bundling? Boy, now we're thinking like a Magnetar Capital executive. Look, we're talking about Coreweave and their earnings. I couldn't tell you what the actual goal of Coreweave is. If the goal is to make money for the company, Coreweave sucks at what they do. If the goal is to make NVIDIA shareholders rich, Coreweave is very good at what they do. If the goal is to make Magnetar Capital executives rich, then Coreweave is very good at what they do. If the goal is to make money for Coreweave shareholders, then Coreweave sucks at what they do because all they do is burn shareholder capital. So what is the reason for Coreweave's being? Probably make Magnetar and NVIDIA rich, which lines up with what Gil Loria said when he came on the channel about a month ago. He said Coreweave appears to be a special purpose vehicle propped up for the sole purpose of inflating the demand for NVIDIA's product. And it has done exceedingly well toward that end. And ever since it's done that, you may notice, fun fact, go look through Coreweave's executive roster and the people who work for Coreweave and their board of directors and see how many of them are current or former Magnetar Capital executives or board members, and how much stock-based compensation they're getting along with base salaries of $300,000-$400,000 a year. Magnetar is freaking pigging out at this trough. Oh, by the way, Coreweave's lockup period ends tomorrow at midnight. So all the people who aren't allowed to sell shares because of the IPO, that goes away, I guess starting Friday morning. So the Coreweave IPO lockup expiring, that's going to be a fun one to watch, especially after earnings disappointed and the shares are down 10% on disappointing earnings. Yeah, what is the goal? Is it to make money? I don't think the goal is to make money, Pasta. I think the goal is to make Jensen and company rich, and the goal is to make Magnetar rich. And they're doing very well at that. Sooner or later, people are going to realize what Coreweave is. And, all these clowns and chodes and degenerate pricks that are in my Twitter feed every time Coreweave announces some BS headline and it convinces more idiots to pile into the stock, they're all going to disappear when this company goes bankrupt. Do you think they're going to stand up and be like, oh, whoops, my bad. It turns out it was a fraud all along. Gee, I'm sorry. You think they're going to say, no, they're not going to say that. They're just going to disappear quietly into obscurity. And, they will be missed when that happens. What can I tell you? Thank you, Pasta Man, for supporting the channel, sir. And he's back again. He says he was referring to real estate. Well, crap. I guess that whole rant was totally out of place. Sorry, I got Coreweave on the brain when clearly we're talking about Coreweave. All right, so allow me to reiterate. Is the goal to make money for the commercial buyers, or is it to structure bonds and sell them into retirement funds? Okay, a fee shop. That's a fun way to put it. Yeah. Hey, think about, we talked about this on the Zoom call for the last couple of weeks about institutional buyers buying up brand new homes in and around the Tennessee area. Why? Because they need to get some new homes to lower the maintenance cost, the average maintenance cost on this bundle of other homes that they bought, so they can real quick dump it into a bond, get it off their books before prices crash. Absolutely, it could be just all about structuring to sell bonds and collect on fees. Why not? I mean, it's what they did in 2008, 2009. That's why they were so happy. They were making loans to people who they knew couldn't pay them back. They didn't care. They were collecting their fees. And if they crashed the market, well, we'll just buy those assets back at pennies on the dollar and make a ton of money coming out of it. Entirely plausible, Pasta Man. And I'm sorry, I took your real estate question and made it all about Coreweave. Well, I guess my brain just goes where it wants sometimes. Chalk that up to confirmation bias, maybe? I don't know. Either way, thank you, Pasta Man, for supporting the channel. And thank you, everybody, for having your coffee with the Melon Heads this morning. Appreciate that very much. Don't forget that like button and that subscribe button on the way out for the algorithm. Thank you guys for the super chats. Also, shout out to my magnanimous Melon Heads on YouTube and Patreon. Thank you guys for supporting the channel. Links down below should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.